Interest rates are slowly coming down. And with this single shift, it's quietly changing how much home you can realistically buy in 2026. It's not just the listing price or what it says on Zillow or what your friend said that he sold his home for recently. What the silent killer really is interest rates. Because in today's market, interest rates does not just affect the loan amount, but rather the home itself. It determines the monthly payment and really what it is affordably. So today in this video, we're gonna be talking about what's happening with the interest rates and why it's super important. I'm also gonna be talking about what PMI is and how it affects your monthly payment. Then we're gonna go into some financial rules such as the 28% rule, the 36% rule, and the 30-33 rule. So if you guys haven't met me, hello, I'm Michael with Razo Legacy Home Group, a mother-son real estate team that serves the greater Austin area. All of our contact information is gonna be in the description below. So first, interest rates, where are they at right now? At the peak of the market, many buyers were seeing mortgage rates in the high 6s and even into the low 7s. But right now, we're closer to the low to mid 6%. You guys, a 0.5% doesn't sound like a lot, but when you really look at it from a 30-year loan, it affects how much you'll be paying from thousands of dollars. And that is why with every single client that I talk to, we talk about interest as one of the most important things. Guys, here is the idea I need you to understand. Interest rates control your monthly payment. And the monthly payment controls the affordability, which ultimately leads to how much home you can actually buy. You see, most buyers just shop whatever the listing price is. If it's a $400,000 home with $300,000. But you see, banks do not. Banks approve you based on monthly payments. And so this includes principal, interest, taxes, insurance. And that's why price alone doesn't tell you exactly how much you can afford. Let me show you how powerful interest rates are in 2026. Home A is priced at $300,000. The interest rate is 6.5%. With taxes and insurance included, the monthly payment comes out to $2,250 per month. Now look at Home B. Home B is priced at $440,000, but because it's a new construction, the builder is offering incentives. This includes a 4.0 interest rate and as well as closing costs paid for. And with the taxes and insurance included, the monthly payment is also around $2,250. Guys, nothing has changed but the interest rate. You afforded more of a home with a lower interest rate compared from a 4% to 6%. Now I want to talk about another silent killer that adds to the monthly payment, and that is PMI. If you put less than 20% down when you're buying a home, the lender is often going to add this thing called PMI, or private mortgage insurance. What PMI does is it protects the lender from any mishaps that may happen with the loan. But once you reach around 20% of your equity inside of the home, you can just give them a call and be like, hey, I don't want this anymore, and they just get rid of it for you. But just like interest rates, PMI affects how much you'll be paying monthly. Now that we got all the payments out of the way, I want to talk about this rule called the 28% rule. Most lenders will be using this 28% rule, and what this is saying is that the monthly payment of your house, your PITI, should be no more than 28% of your gross monthly income. For example, if you're making $100,000 per year, that's about $8,300 per month before taxes. And 28% of that is roughly $2,300 per month. And under this rule, that's your comfortable housing target. And banks can approve you for way more, but that does not mean you're comfortable inside of it. This rule basically looks at your monthly debt combined. So think of student loans, credit card debt, car loans, and even your mortgage. It is the monthly payment, so the minimum amount, can be no more than 36% of your gross income. Let's say you're making $75,000 a year, and that's around $6,250 per month. And 36% of that is $2,250. So that is basically how much debt you can take on. So let's say you're paying $700 a month for all your other debts. This leaves you with $1,550 per month for your house. Now, finally, I want to talk about the personal finance, the 30-33 rule. This isn't a lender rule, but rather a rule that you should follow just financially. It suggests that 30% of your income goes towards the house payments, and then the other 30% goes towards your savings after buying the home. What the other 3 represents is that you should not buy anything more than 3 times your annual income. So let's say if you're making $100,000 a year, this means you should buy no more than $300,000 worth of a home. So guys, in 2026, the buyers who will gain the most leverage inside of this market is the ones who understand that interest rate makes up your monthly payment. And when you guys understand these simple rules, you won't just be able to buy a home, but you also be able to live affordably. So if you guys are looking to buy a home, our contact information is going to be down below. YouTube suggests that you should watch this video, so you should click on it.